Imagine a perfectly closed economic system, one where every rupee of corporate profit flows directly, without interruption, straight to the business owners. Think of this system as a single, sprawling dynasty. Let's call them the Gotrocks family. Together, they own 100% of the nation's corporations. Because they own everything, their wealth creation requires absolutely zero effort. As the nation's businesses generate earnings and pay dividends, all of that aggregate profit goes straight into the family's pockets. This powerful thought experiment was designed by John C. Bogle. He is the architect of the first index fund and the pioneer who completely reorganized the mechanics of global passive investing. To understand his impact, you only need to listen to Warren Buffett, who stated that if a statue is ever erected to honor the person who did the most for the everyday investor, it should be Bogle. Bogle realized that true structural investing wasn't about outsmarting the market. It was simply about capturing the raw, friction-free economic growth of a nation's businesses. But that frictionless system did not last. Soon, intermediaries arrived on the scene. Bogle refers to them as the helpers, the brokers, active fund managers, and financial advisors. They pitched a seductive idea to the individual family members. Give me your share of the business, let me trade it for a better one, and we'll beat the family's average return. The market quickly shifted from a quiet wealth generation engine into a frantic transactional trading floor, where everyone was suddenly buying and selling shares against each other. We have to step back and ask, did the aggregate corporate profits increase because of all this trading? Did the underlying economy actually grow any faster? No. The only structural change to the system was friction. Every single transaction triggered a fee or a commission, systematically siphoning wealth away from the family and into the pockets of the helpers. Today, Indian retail investors are the Gotrocks family. Whenever we buy active mutual funds or trade stocks continuously, we invite an army of intermediaries into our portfolios. Active investing transforms a closed system of pure corporate profit into a casino. And in the investment casino, the house always takes a cut. Active investing is the relentless pursuit of identifying winning stocks from thousands available in the market. It is the financial equivalent of trying to pick a needle out of a haystack. This approach carries severe hidden costs. To find those winners, fund managers engage in relentless portfolio churning, which racks up massive transaction fees and triggers constant tax burdens. The mechanical counter to this is passive investing. Bogle considered it the only purely common-sense approach to building long-term wealth. This diagram shows the mechanical difference. Instead of spending resources searching the haystack, passive indexing buys the entire haystack. This static network requires zero human bias, eliminates costly predictions, prevents unnecessary trading, and neutralizes management fees. There is a governing law. Every unit of active effort creates a unit of friction, directly reducing your net return. Most investors look at an active fund's 2% expense ratio and dismiss it as a minor convenience fee. They assume 2% is just too small to matter. This chart maps a 10 lakh investment over 30 years. At a frictionless 15%, it compounds to 6.6 crore. A 2% fee drops returns to 13%, terminating at just 3.9 crore. That tiny fee creates a staggering 2.7 crore gap. The brutal mathematical reality is that your 2% annual fee actually cannibalized roughly 40% of your total terminal wealth. Look at the risk-to-reward asymmetry. You provided 100% of the capital and absorbed 100% of the risk, yet the manager extracted 40% of your upside. Bogle termed this the tyranny of compounding costs. In the investment ecosystem, the more the managers take, the less the investors make. The natural reaction is to believe you can simply identify a star fund manager, someone so skilled they will easily outpace the market average and justify their fees. This scatter grid plots Bogle's empirical data, 350 active mutual funds over a 30-year timeline. Over 3 decades, the vast majority fail, close, or merge into obscurity. A microscopic fraction, barely 1 to 2%, actually survive to beat the index long-term. The statistical force driving this failure rate is known as regression to the mean. A massive 40% return is usually a lucky outlier. Mathematically, that performance is bound to lose momentum and revert downward to the market average in the subsequent years. Identifying that tiny 2% of winning funds 30 years in advance is a statistical impossibility. Relying on active manager selection is a trap that destroys long-term capital. The definitive structural solution to bypassing the helpers is brilliant in its simplicity: the low-cost index fund. In the Indian market, this means utilizing the Nifty 50 and Sensex as the direct proxies for the nation's economic engine. Buying a Nifty 50 index fund automatically makes you a partner in the top 50 companies in India. It requires zero human decision-making and completely cuts out the middleman. This chart illustrates the extreme cost advantage. The expense ratio plummets from a towering 2% active fee down to a near-invisible 0.05%. This near-zero structure mathematically guarantees the investor captures the exact economic growth over the coming decades. No leaks, no hidden cuts. Index investing strips away the noisy speculation of market expectations, allowing you to strictly capture the enduring reality of real business growth. Bogle distilled this philosophy into 4 foundational rules. First, the absolute core of your long-term portfolio must be anchored in low-cost, broad-market index funds. Second, never underestimate compounding costs. Extreme fee minimization is the single most powerful lever you have for retaining your own wealth. Third, abandon the ego that you or your highly paid manager can outsmart the aggregate intelligence of the market. And the final, hardest rule: buy and hold. Khatam roktar bakir ho. Once automated, the greatest threat isn't market volatility. It is your own emotional urge to intervene when prices drop. True wealth creation is not a frantic sprint. It is the boring, patient, mathematically guaranteed capture of aggregate human progress. Don't just do something. Stand there.